Hello all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on Bittersweet Balance, Credit Outlook amid shifting sugar and ethanol dynamics. We sincerely appreciate your taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Anup Kumar, Managing Director at SUCDEN India Private Limited. Mr. Sunil Ranka, Chief Financial Officer at Shree Renuka Sugars Limited. Mr. Sabyasachi Majumdar, Senior Director at CareEdge Ratings. This session will be moderated by Ravleen Sethi, Director at CareEdge Ratings. We will commence the session with a presentation by Sahil Goyal, Assistant Director, and Sidharth Wadhwa, Analyst at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Sahil to make the presentation?
Thank you, Mamta. Good afternoon, everyone. In Sugar Industry webinar today, we will be presenting at length the key updates in domestic and global markets, the structural changes, and key financial implications for the sector. The key messages of today's webinar revolve around the evolving dynamics of sugar sector. India's sugar production is projected to decline by approx 12% in season 25 due to lower cane quality in key producing states. This is a sharp drop but not unexpected given erratic rainfalls and pest issues during the planting season. However, season 26 is expected to mark a strong recovery, with output likely to rise by 10 to 11% year-on-year, supported by normal monsoon conditions and improved sugar recoveries. This production trend, along with government policy on exports and blending, has influenced domestic sugar prices, which have risen by around 2% in season 25 and are expected to remain firm going forward, driven by tight inventory levels and a likely 2 to 3% upward price bias. Though on the global front, a surplus of 5.3 million tons is projected for season 25, potentially increasing to 11.4 million tons in season 26, which could exert downward pressure on international prices. However, domestic prices in India are expected to remain relatively insulated. Regarding exports, the government has allocated a quota of 1 million tons for the current season, with 4.24 lakh tons exported as of April 25 and expectations of reaching 9 lakh tons by season end, making export developments a key monitorable for the coming year. Meanwhile, the ethanol blending program continues to be a bright spot for the industry. Lifting diversion restrictions and permitting the use of FCI rice may see higher blending currently. And further, with long-term benefits of ethanol, government may aim 30% ethanol blending in next 5 to 6 years. On the profitability front, firms are expected to benefit from higher distillery volumes, notably B-heavy molasses and cereals-based feedstock, firm sugar prices, better recoveries, and improved capacity utilization. CareEdge Ratings anticipates operating margins to expand by 100 to 150 basis points in FY26, though still remaining below FY24 levels. As we proceed through the presentation, we will delve deeper into how the credit outlook is evolving amidst the shifting dynamics between sugar and ethanol. In the first few slides, we will cover the current scenarios of sugar sector, including production trends, price movements, and inventory outlook, both in the domestic and global markets. This slide gives a quick overview of the global sugar footprint and also the major sugar producing states in India. As can be seen in Exhibit 1, which shows the global production, India is the second largest producer of sugar in the world after Brazil, accounting for 17 to 19%. Brazil accounts for 24 to 25%, followed by EU accounting 9%, and Thailand being the next, accounting for 6%. States, namely UP, Maharashtra, and Karnataka, contribute more than 80% of the India's sugar production, with UP holding the highest share in the pie. This is illustrated in Exhibit 2. UP alone produced close to 36%, followed by Maharashtra with 31%. Sugarcane remains one of the most attractive crops for Indian farmers, driven by its consistently higher government set prices, SAP and FRP compared to MSPs for crops like paddy and wheat. This further strengthens by dual assurance built into the system. Farmer receives a guaranteed price and mills obligated to procure cane within their catchment area. This mutual dependence ensures stable demand and incentivizes sustained cane cultivation as illustrated in Exhibit 3. Sugarcane acres increased year-on-year till season 23, as shown in Exhibit 3. However, marginal drop is registered in season 24 and 25 due to poor monsoon forecast and red rot disease outbreaks in Uttar Pradesh. However, with a shift towards disease-resistant varieties and a normal monsoon expectations, acreage is likely to recover near season 23 levels in the coming seasons. Similarly, yield decline over the past two seasons due to same factors, that is adverse weather and disease stress, as shown in Exhibit 4. But with improved weather outlooks and better crop planning, season 26 looks improved in terms of both acreage and yield from an year-on-year perspective. Let's now have a look at the sugar balance sheet over the years as shown in Exhibit 5 to understand how production, consumption, blending, exports, and policy shifts have interacted. India witnessed a record sugar production in 2022 at 39.2 million tons. After that, the production witnessed a consistent decline, and with estimated fall of around 12% in season 25 to reach 29.9 million tons, owing to the subpar monsoons and disease-related crop stress as discussed earlier. Historically, exports have played a key role in balancing the sugar surplus in years of higher production, especially in season 21 and 22, and prevent excess inventory buildup and supported better price realization for mills, keeping domestic prices in check. However, as the ethanol blending program gathered pace, there was a strategic pivot from exports to ethanol diversion. The government began prioritizing ethanol blending as a long-term structural solution for surplus management, offering mills a more stable and remunerative alternative to exports. This shift was evident in policy responses. When production pressurized emerged due to weak monsoons and disease outbreaks, the government curtailed exports in October 23 and temporarily restricted ethanol diversion in December 23 to November 24 period to ensure domestic sugar availability. Looking ahead, while export remains a tactical lever to balance sugar availability, ethanol blending is now the strategic focus, aiming to provide long-term demand visibility and improved cash flows for integrated sugar players. As season 26 production is expected to recover moderately, this delicate balancing act between exports, ethanol, and domestic availability will continue to shape industry dynamics. Though a relaxation has been announced with 1 million tons of exports now permitted for season 25, as production is expected to be higher than envisaged earlier and shall be sufficient to cater to the domestic sugar demand and partially store ethanol diversion targets. However, CareEdge estimates only 90% of this quota will likely be utilized given the tight supply scenarios and India to end season 25 with closing inventory of 5.5 million tons. Going forward, despite of expected increase in production and consumption to largely remain stable, and with rising thirst on sugar diversion toward ethanol, exports are projected to remain on the lower end balance at season 26 end, which is projected at around 5 million tons. With these inventory levels, let's take a look at the sugar pricing movements in India. As shown in Exhibit 6, sugar prices have remained volatile over the past few years, influenced by fluctuating production, policy changes, and global trends. Recently, prices surged sharply due to lower production, tight inventories, diversion toward ethanol, and rising input costs, reaching rupees 4,100 to 4,200 per quintal by March 25. These levels are well above the current MSP of rupees 3,100 per quintal, which was remained unchanged since 2019 and may warrant government interventions, especially as sugar is an essential food commodity. Looking ahead to season 26, prices are expected to remain firm, with a possible uptick of 1 to 2%, as it will take time for inventory levels to normalize while demand stays stable. Prices are likely to stabilize around 4,250 rupees per quintal unless there is a strong policy response. From a long-term perspective, as the production improves and inventory reaches comfortable levels after accounting for the diversion toward ethanol, the prices may ease out a little bit. Now, coming on the global front, as shown in Exhibit 7, the global sugar balance sheet is expected to be in a surplus of 5.3 million tons against the deficit of 0.4 million tons in season 24 on account of production of 181 million metric tons of sugar in season 25, which is the highest in last 5 years. This surplus is on account of increase in production primarily in Brazil, China, European Union, and Thailand, which is partially offset by lower production in India. As the production in India returns to the normal levels and production in Brazil and EU further increases, the global surplus is expected to rise to 11.4 million tons in season 26, highest balance reported in past 5 to 6 years. However, this remains moderable in key producing countries and their weather conditions. The expected surplus has already started impacting the growth prices as shown in Exhibit 8, with price for white sugar consistently falling from the high of USD 618 per ton in season 23 to USD 508 per ton in season 25 on an average, with further expectations of fall to around USD 480 to 490 per ton levels on the back of excessive sugar inventory piling up. However, domestic factors including tight inventory position and lower dependence on export will keep Indian prices relatively insulated from the dip in global prices. Now, I will pass it over to Sidharth to discuss the ethanol diversion strategy, pricing outlook, and blending targets in more detail in the upcoming slides. The dynamic balancing act between food and fuel security that policymaker needs to manage. The financial matrices and rating dispersion of sugar companies will also be taken up thereafter.
Thank you, Sahil. Thank you, Sahil. As we have understood till now, Indian sugar players have been shifting towards ethanol blending, which has been a game changer for them. Let's have a look at the story so far and what lies ahead. Ethanol blending has played a key role in supporting India's energy and economic goals. It benefited various stakeholders, such as the government, for which it has resulted in a forex savings of around 94,300 crores, as ethanol has substituted 17.3 million metric tons of crude oil between ethanol supply year 19 and 24. This has also promoted cleaner air by reducing over 21 million tons of carbon dioxide emissions annually. For sugar mills, it means diversified revenue and protection against sugar price volatility. Farmers, of course, benefit from the faster payments. India's progress in ethanol blending has been notable, driven by strong government support through GST cuts, interest subvention, and flexible feedstock policies, along with active participation of private players, as it provides higher profitability to the sugar mills. This shift from export dependency to domestic ethanol blending with long-term offtake contracts by OMCs and adoption of flex fuel vehicles has provided mills with a more stable revenue stream. India has successfully achieved 20% blending of ethanol in petrol in March 2025 as shown in Exhibit 9, highlighting not just the strong government policies but also the proactive roles played by the sugar companies in realizing a more sustainable future. By the end of ethanol supply year 25, we expect the blending on an average basis to remain between 19 to 20%. With such kind of achievement, India as a nation is heading towards even higher blending. The government is considering policy changes and creating a roadmap for E30. For this purpose, greater focus is needed on expanding grain-based feedstock, infrastructure development, and faster adoption of flex fuel vehicles. This ensures sustainable scaling rather than just complying with the policy intent. CareEdge Ratings anticipates that this would require nearly doubling of the ethanol supply, with estimated demand reaching around 8,500 crore liters by 2030. Beyond environmental gains, ethanol blending delivers significant economic benefits from forex saving by reducing fuel imports. Ethanol blended in petrol reduces the requirement of petrol for running the vehicles, and India has already substituted 17.3 million metric tons of crude oil with 707 crore liters of petrol savings in ethanol supply year 24 alone. India has nearly saved 94,300 crore in foreign exchange till 2024. And if India is able to achieve 30% blending by 2030 in a phased manner, CareEdge Ratings anticipates another 3 to 3 lakh crores in cumulative forex savings in coming 6 years, as shown in Exhibit 10. Thus, the impact of ethanol blending is dual: positive environmental effect and stronger economic resilience. Let's now take a look at the pricing of ethanol based on different feedstocks, as shown in Exhibit 11. Ethanol derived from maize is typically associated with lower margins and hence has been priced at Rs 72 per liter for ethanol supply year 25. Exhibit 12 highlights the relatively higher allocation of maize over the last 2 years, and this shift has been driven by reduced sugar production and earlier restrictions on sugar diversion. As discussed earlier, to meet the growing ethanol demand, producers have increasingly turned to grain-based feedstock, with maize emerging as a primary non-sugar alternative. However, with the sugar production recovering and diversion restriction lifted, we might see syrup could increase its share as the dominant feedstock for ethanol production in the next year. Prices of ethanol produced from C-heavy molasses, B-heavy molasses, and sugar syrup, which exclusively came from the sugar industry for ethanol supply year 25, have been fixed at rupees 58, 61, and 66 respectively. While price for 1 liter of ethanol produced from FCI rice or damaged food grains would fetch rupees 59. In last 2 years, there has not been any increase in the prices of ethanol, except for a marginal increase in the price of ethanol produced from C-heavy molasses. There has been constant appeals to the government for increasing the ethanol prices. However, there has not been any update as of now regarding the price hike of ethanol for ethanol supply year 26. Thus, only the marginal improvement is expected in the profitability from ethanol in the future, which is subdued currently. In case prices are increased over CareEdge's assumption, it will entail additional profits for the sugar companies. The segment-wise financial performance will be discussed in the detail in upcoming slides. Now we will be presenting the financial matrices and rating dispersion of sugar companies. First, let's take a look at the financial performance of sample companies in the sugar industry selected by CareEdge Ratings along with expectations for financial year 26. As shown in Exhibit 13, the effect of erratic monsoon and the red rot disease coupled with restrictions on diversion for sugar season 24 is visible in the top line of sugar companies, which remained flat in financial year 25. With the expectation of normal monsoon, improved recoveries, and relaxation in diversion norms, the top line is expected to register a 9% growth in financial year 26. Now, coming to the profitability of these companies, there was a sharp decline in the absolute EBITDA levels in financial year 25 because of significant increase in the input costs, lower recoveries, and lower feedstock availability. The EBITDA margin also remained the lowest in 5 years because of rising input costs, though slight improvement is expected in financial year 26 owing to expected better recoveries and production leading to better capacity utilization and favorable policy changes. We will dive deeper into the underlying reasons for with segmental breakup next. The ethanol blending program has incentivized sugar companies to scale up ethanol production, providing revenue diversification and long-term cash flow visibility. As a result, the distillery segment's share in revenue has steadily risen from FY24, though sugar remains the dominant contributor. In financial year 25, various reasons led to lower growth in distillery revenues, including lower feedstock availability and diversion restrictions in sugar season 24. Exhibit 16 highlights the disproportionately high EBIT contribution of the distillery segment relative to its revenue till financial year 24, driven by historically superior ethanol margins. In financial year 22 and 23, distillery revenue averaged around 20% of the total revenue, yet it accounted for 40% of the total profitability. However, this trend has reversed in financial year 25 due to lower profitability from grain-based ethanol. Over the last 2 years, ethanol prices have remained largely stagnant, while the FRP and SAP of sugarcane have steadily increased. For instance, FRP rose from rupees 305 per quintal in sugar season 23 to rupees 355 per quintal in sugar season 26. This widened the sugar to distillery transfer price, compressing distillery margins, and in some cases making sugar production relatively more profitable with hike in sugar realizations. Moreover, lower utilization and higher sales volume of ethanol produced from maize, whose margins were lower as compared to substituted food grains, which were available till July 2023 at rupees 20 per kg, resulted in lower profitability for distillery segment. Going forward, while the distillery profitability is expected to improve slightly in financial year 26, it is expected to remain subdued unless ethanol prices are revised upwards. Next, we have the revenue and EBIT margins for sugar, distillery, and cogeneration segment separately. As we discussed earlier, the revenue for sugar remained flat in financial year 25 with a slight decline in EBIT margin from 7% to 6% due to lower recoveries. As the monsoon returns to normal and the recoveries improve, the revenue is expected to return to high levels achieved in financial year 23 with the improved margins. Various representations have been made to increase the MSP of sugar. However, we are yet to see any update on that. For ethanol segment, while the outlook is expected to improve in comparison to previous years, it remains bleak. The growth is bound to be hampered because of the rising cost with no corresponding increase in the prices. Hence, CareEdge Ratings expects a slight improvement in the margins in financial year 26 with marginal increase in revenue as diversion is lifted and the share of ethanol produced from sugar syrup and B-heavy molasses is expected to increase. The performance of the cogeneration segment, which is closely linked to the cane crushing volumes, is projected to see an uptick in revenue in financial year 26 with margins likely to remain stable. Overall, the profitability trajectory for sugar companies will significantly hinge on policy actions, particularly any upward revision in sugar and ethanol pricing. At last, let's take a look at the credit profile of the companies rated by CareEdge. Close to two-thirds of the sugar companies rated by CareEdge fall in the investment grade category, that is double B, triple B minus or higher, with 17% companies in double A band and 21% in A band. 30% of the rated portfolio is in the below investment grade category, that is double B plus or lower. These are largely the players with low capacity and non-integrated operations. The credit ratio, defined as the number of upgrades for every downgrade in rating, also fell in financial year 25 because of deterioration in the financial risk profile of the companies with lower profitability, particularly in the ethanol division. Sugar industry is fragmented in nature, with none of the players holding double-digit market share in India, and thus there are only a few large players in the industry, which is visible from the percentage of companies in the double A band. While financial year 24 was a good year with a credit ratio of 5, financial year 25 saw a credit ratio of 2.33, owing to moderation in financial matrices of the companies. With this, we come to an end to our presentation. Thank you, everyone. Now I would like to hand over to Mamta. Over to you, Mamta.
Thank you, Sahil and Sidharth. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Ravleen to take over the session, please? Ravleen Sethi serves as a director at CareEdge. She's a qualified chartered accountant with over 14 years of extensive experience in corporate accounting and credit rating. Throughout her career, she has demonstrated expertise across a broad spectrum of industries, including cement, hospitality, healthcare, and sugar, among others. Over to you, Ravleen.
Thank you, Mamta. A very good evening to all our panelists, and I would request all of them to please switch on their videos. And thank you, Sahil and Sidharth, for a very comprehensive presentation. I will start with a quick round of introduction for our guest speakers. First, we have with us Mr. Anup Kumar. Anup is a managing director at SUCDEN India Private Limited, a soft commodity trading company. Anup brings over 27 years of global experience in this field and has worked across the globe, particularly in Indonesia, Singapore, and United Kingdom. Prior to SUCDEN, he was associated with Olam Group, a Singapore-based food and agriculture supply company. He's an IIM Calcutta and an IIT Varanasi alumnus. A very warm welcome, Anup. Next, we have with us Mr. Ranka from Renuka Sugars. Mr. Sunil Ranka has been associated with Shree Renuka Sugars for over 7 years and has an overall experience of more than 40 years with large engineering projects, startup in telecom services, and infra and renewable energy industry. He has previously worked with prestigious companies in senior leadership positions such as Blue Star, Vodafone, Indus Towers, and Reliance Jio and Suzlon Group. He's graduated in commerce from NM College, Mumbai, and has done CA, CMA, and CS and law as well. A very warm welcome, Mr. Ranka.
Thank you.
Next, we have in our panel with us is Mr. Sabyasachi Majumdar, who is a senior director with CARE. Mr. Majumdar is a senior director at CareEdge and has over 25 years of experience in credit rating and sectoral research across diverse sectors such as power, renewable energy, cement, sugar, chemicals, and oil and gas. He's an alumnus of IIM Lucknow and Delhi College of Engineering. Thank you, Sabyasachi, for joining us.
Yeah, thanks, Ravleen.
So thank you, everyone, for taking out time and being present here with us. And after this comprehensive presentation, maybe I'll start with you, Mr. Ranka. Given the erratic monsoon patterns and the pest issues which the industry has witnessed in the last sugar season, how is the industry, gauging the cane availability and quality when we are heading towards the next sugar season, which is 26 we are talking of? Also, will sugar production be sufficient to meet both the domestic consumption and the ethanol diversion as we are projecting? Because as CARE, we are projecting a 10% rise from sugar season 25 in production. And we are also expecting a diversion of close to 4 to 4.5 million tons. So what is your view on the same?
First and foremost, Ravleen, thank you for this opportunity. Okay. We are in, highly agricultural-based industry and we are subject to vagaries of monsoon and typically in the sugarcane side, we also have the pest infestation, the pest disease. So last year, typically what happened was we had very erratic monsoons and also, especially in parts of Maharashtra and Karnataka, and we had the pest diseases in UP, which has been one of the largest producing states in the country. As a result, we are ending up, the sugar season 25 is yet to end officially, but the crushing is over. we are going to end up with an estimated production, sucrose production as we call, roughly around 30 million tons of sucrose, out of which 3.5 to 3.75 will get diverted towards ethanol. So we will be left with around 26 million tons of sugar available, and to that you add the opening stock of approximately 8 million tons that was available. So we had 34 million tons of sugar that was available in the market during the year. Out of that, removing our normal consumption is around 28-29 million tons. So and we did have an export of the government did announce an export of 1 lakh tons, 1 million ton, and on account of policy decision or other factors. Taking all that into account, I think we're left with a very low closing stock compared to the earlier year. India has always been a sugar surplus country in the earlier years. You would have seen in the chart as well, 2015, 16, 17, 18. And then the good thing happened with the ethanol blending program, so that it got an evacuation. The sugar got evacuated. So we left with a closing stock of 4 million tons. Now, in the current year, the forecast is above normal monsoon, and we've also seen that the crop area, the sowing is improving, especially in Maharashtra and Karnataka, and also in UP. So the estimation as of now is somewhere around, and it's too early. Let me tell you, it's just too early, because last year also same thing happened. We estimated something, we ended up with something because of the erratic monsoon pattern, which really, doesn't allow you to make a very good forecast. So we estimate around 37 million tons of sucrose production, out of which roughly 5.5 million tons will be diverted towards ethanol. So you have a good, 32 million tons plus the opening stock, and that will be, I think, adequate and sufficient reserves in terms of to take care of our consumption needs this year. And this will also help in achieving our, blending target, the ethanol blending target by way of the diversion. So we feel there will be adequate at this point in time.
Okay, sure. Thank you for that input. We as CARE, rating agency, so we are targeting close to 34. So you are expecting a 2 to 3 million ton higher production. So that
mine is sucrose production. So I'm talking of sucrose.
Sure. And
so
that would
after the diversion, it is more like 32.
Okay. Sure. So great. I move to you, Anup. In the light of the disease outbreaks, like we saw the red rot effect, widely grown cane variety in UP, which was 0238, was getting affected. How advanced, in your view, is the industry in adopting more resilient or higher yielding cane varieties? And what would be the effect on the overall productivity?
So I think the renovation of the field or renovation of a variety is a slightly longer term project. It does not happen overnight. 238 has been a very stable variety. It's sort of turned around UP cane production for many years. The problem sort of became evident about 3 years back. Since then, all bodies, government and private, have been working to change the profile of the cane in the field. As of today, I think what the millers in UP tell us is that they've managed to get about 70% in 238. So they've got about 30% of new varieties. There is not a single variety which has taken its place. There's 237. There is, I think, 1538. And there are a couple of other varieties which were being talked about as possibly coming in. But the issue with them is while they have equivalent recovery profile, they have a lesser yield. And in UP, where you're paying the farmer by the tonnage that he brings in, a farmer is not very keen to replace a variety which reduces his yield, his tonnage per acre, which is why we feel that the farmer will probably resist. Hopefully, we will see some changes happening soon. But I'm not very confident that the 238 can be removed overnight. And I guess it's a few years before it gets out of the way.
Okay, sure. That's very helpful. So you said that still the new variety would be close to 30% and 70% is still 0238 only. Is the largest.
Yes, so it's I would say not very well spread out. Again, mills which are progressive, which pay the farmer better, have better relationship with the cane, they're with the farmers, they're able to persuade the farmer to move to something better. better for the mill is better for the farmer as well. Mills which are lagging in their payments to the farmer, have poor relationship, don't have so much on-ground presence, are the ones which are lagging. So I think it's related to which mill you're talking about and the cane area for that mill.
Sure. But on an average, from an industry perspective only, I was saying, you're saying that 30%, 30 to 35% maybe the newer variety which is there.
Yeah, for the state, yes.
Yes. Okay. Okay. Thank you. So I'll get in Sabu over here. Sabu, given your experience and interactions with multiple companies over the years, can you please put in some light, how do you feel, or as per our interactions, how are the mills adapting to this regional difference of varietal risk? And what more India can do to improve its cane productivity and recoveries? What is your take on it?
I think there are multiple things which can be done for improving the overall sugarcane yield. It's a very important crop. I think what some is not often appreciated is that sugarcane is one of the most profitable crops that farmers can grow, and one of the reasons why it's inherently so profitable is that compared to almost any other crop, it fixes more biomass. I mean, it simply produces more tonnage of crops on a dry basis compared to any other crops. And while it's often seen as a water guzzler, once you adjust for the the amount of biomass that you're yielding, it's not that much of a biomass. I mean, water guzzler compared to, let's say, paddy. Now we need to look at various reasons, various regions of the country where we need to look at the sugarcane production. Now, if you come to the north, for example, where CO2 rate has been a great success, but obviously, over a period of time is going to lose its steam. I mean, any crop over a period of time, becomes vulnerable to pest and other, pest pathogens, etc. And obviously, as Mr. Anup points out, that replacing it is not going to be very easy, because some crops may give a very good recovery, but not the same yield. Others may give you a good yield, but not the recovery. So it's very difficult to come. So the only way to address it is to really do more in R&D. I mean, obviously, the government has to be also a part of the story. The government and the private sector, everyone has to work together. The agriculture universities, they have to all work together for on the varietal mix, so that we are able to have succession of several varieties which have the same property of high yield as well as high recovery rate. The other thing we need to look at is, if you move away from the north, I mean, if you're looking at, let's say, parts of Maharashtra and even more in the south, there are other factors which are, causing, production to stagnate. And this basically include, labor availability, because in the southern and western parts of the country, labor has become very expensive and is not even sometimes available. And second thing is that there are water, shortages in many important parts, which have resulted in acreage getting dropped. So to address that, basically on the labor side, you'd have to look at labor saving practices as well as devices. For instance, you could look at wider spacing of sugarcane, which results both in water saving as well as in labor saving, in the sense that they allow this harvesters, the large scale harvesters, to become more practical. So obviously, there has to be a lot of investment, probably backed by some amount of government subsidies in in drip irrigation for water conservation, and so that the same amount of water can produce more sugarcane, as well as wider spacing and introduction of sugarcane harvesters. So broadly, these are the various techniques which can be used for boosting sugarcane production. And of course, like in any other crops, better soil, better looking into the soil health, use of artificial intelligence, drones, etc. I mean, all these which are common for all crops, they can be used in the case of sugarcane also.
Okay, great. Thank you so much. Let me get Mr. Ranka back into the conversation. So, Mr. Ranka, as we talked of, in the presentation, that ethanol blending has also contributed in changing the dynamics of the sugar players in last few years. We wanted to get your views on, the feedstock related challenges, even, maybe also the technological logistic challenges that we would face as an industry. and for sustainably scaling up the ethanol production. This could be obviously for sugar players and obviously the standalone distilleries as well. But talking more from a perspective of the sugar players, could you help us, please, with your views on it?
From the sugars, I mean, if you look at the ethanol blending program that the government laid out, and this is, and we talked about by 2020 we get into 20% blending, and which we have today fortunately achieved. As we are, and that translates to roughly 10 to 6 billion liters of ethanol supply. And encouraged by that, the government is also talking about now to move to by 2030 to 30%, which is roughly translating 30 billion liters of this. And this is primarily driven from the fact that India wanted, the country wanted, energy security. We have seen what we have faced, during COVID and otherwise also, our balance sheet, the country balance sheet is so vulnerable to oil prices and foreign exchange. So the government is rightfully thought that we should move towards energy security in this direction, and therefore they brought this program. And initially they've given very good support in terms of not directly in terms of capital outlay, but in terms of cost of capital by giving us interest subvention. So in terms of the constraints that are facing us today, what I would say is, while on the technological side or on the logistical side, there's not much of challenges. But I think if the policy is, little more certain, and you have a view, a predictable view, a long-term view. What is because as an industry, you keep on investing, and these are high investment projects, and you keep on investing in these projects, and you need some kind of visibility in terms of what is the kind of offtake that will happen. Okay. The year before last, what happened was suddenly the government stopped production of the premium ethanol, especially from cane juice and the heavy molasses, a certain restriction. And then you were, then you were flooded with the sugar inventory levels all across. The sugar prices went down, and the prices go because of surplus. When the prices go down, then you have the cane areas building up, on this side. You have large working capital cycles, the cost goes up. So all this kind of hampers it disturbs the industry quite a bit. So therefore, from a sustainability point of view, I think if we have some predictable feedstock policies, it will be great. I just to talk about the other feedstock. For example, they move towards grain, which is fine, and because there is a lot for everybody here in this country, to move toward 2030. But what has happened to grain? See, if you look at maize, for example, last year, maize suddenly, while the lot of good corn production, maize got diverted towards ethanol, but the poultry industry there was up in arms because they had very little, that's a fodder stock for the poultry.
Yeah.
Similarly, rice, yes, you had surplus rice and you're now supplying at a very cheap rates, very, very cheap rates from FCI, and taking the same, rice-based ethanol at a very, comparatively very expensive. I mean, there's very good margin there. And whereas you look at ethanol, it's very different today. My cost of ethanol is almost coming to 57, 58 rupees, and you supply at 60, 61 rupees. So, these kind of the policy flip-flops that are happening, that is something, that the industry would want an assurance from the government, actually. But you invest, and in terms of installed capacity today, against the 10 million liters of ethanol, we have almost like 13 billion liters of production capacity already installed, and there's more happening as well. Now, here, without any kind of production or something, you just see the interest and the depreciation cost of the industry. Huge amount for those, especially those who are installed and not able to produce anything from there. So I would suggest, my take is that these are the key constraints I think facing. Technological, logistical challenges, absolutely no issue. Yes, there will always be the food versus fuel debate. Should I allow more sugar production, or we get into fuel? Yes, do agree with that, and government will keep calibrating their policies in that sense, but need a long-term stability in terms of certainty, actually.
Sure. So we echo your thoughts, like uniform policies across states also and more long-term policies are required, but also ensuring the readiness of the vehicles are also the need of the hour when we now move from E20 to E30. Because we all do understand that E20, till E20 it is still doable, but now more flex fuel vehicles have to start hitting, and there has to be a more long-term sustained plan of us to be able to blend that level, and also probably the vehicles of that kind of an engine being available.
Should be available. Yeah, absolutely right. I mean, that should be available because flex fuel is still on paper. I mean, in that sense, yes, we have seen something as a sample or test case, but then in long term, all the car manufacturers have to agree, and also at the same time, you've got to balance the efficiency of the car, the mileage and other stuff. So that is I'm sure the government is seized of this, and the ministry will definitely come out with some guidelines very soon on that.
Sure. Anup, how are you viewing this ethanol blending as a structural level for revenue diversification for sugar players or otherwise, your thoughts? Do you agree with Mr. Ranka, or you have, you would like to top up with them a different view?
No, I think it's a very interesting question. Unfortunately, we look at it in a very unidimensional manner, where we look at it from the sake of the industry which we are in. I happened to go to a conference which was a maize millet conference, where the chairman of Mr. Ranka's company, Mr. Atul Chaturvedi, was a keynote speaker. And I find very few people at his level speaking so with such vision and such clarity that it is always a pleasure to hear him. So he comes and he makes no bones. He firstly will deprecate himself, saying that he's not a sugar person. He does not know about sugar. It is a different thing that he knows more about sugar than everyone of us put together. But he made a comment about oilseed industry. So let me just start with that. I'll just take 2 minutes if you don't mind.
Sure.
He said that the soy industry, which makes soybean meal, is currently out of MP, is in a throes of crisis. Why? Because the soybean meal, which is going to the poultry of the country, is being now replaced by the DDGS, which comes out of processing maize or rice for ethanol.
Yeah.
Now, while it cannot obviously go and substitute 100%, but it has largely gone and substituted that. So I think the number was, I mean, forget the number, but the maize and rice DDGS has gone in and substituted soybean, and soybean farmer is then not interested in planting soybean anymore, in which case the oilseed profile in the country has completely changed. Right? We'll probably see other oilseeds come in. We may even see more palm coming in as a resultant, because we don't have soybean, but we still need to import oil. So we may still see more palm coming in. Now, the thing is that with more DDGs going into the poultry industry, the development of the poultry has undergone a significant change. Right? Instead of sort of developing over a X number of days, it's probably developing over a shorter period of days. And that obviously has its own challenges in terms of protein it has and whatever other taste profile, etc. has. Then we look at the maize industry. The maize industry is crying out because the DDGS that they make is not handled, is more prone to aflatoxin infestation or development of aflatoxin, which would mean that it can only get sold at a certain window without aflatoxin, or if aflatoxin develops, it has to go to the cheaper poultry, which means that you can have poultry which is without any aflatoxin, you can have poultry with certain level of aflatoxin, or you can have one with high level of aflatoxin. Rice coming in has again changed all the dynamic, because rice gives more starch and hence gives more ethanol. At the same time, it gives more ethanol, and it gets better DDGs. But the problem is that rice is not with the private industry. Rice is with the government. It is for the government to discount itself by any amount to sell that rice into the ethanol industry. So whereas maize and soybean are farmer-led, rice is not farmer-led. We are not buying rice from farmers or paddy from farmers and making ethanol. You're basically telling FCI that you take a next amount of loss and I'll take rice from you and I'll distill it and make ethanol. And here we have now the sugar industry. So you see, the ethanol is a fantastic intersectionality with all industries where the challenge, and then you look at rice and maize, which are twice a year crop minimum, if not three. Maize happens across the year, across India. We started, let's say, I guess March is when we started in UP, and we'll probably wind up something around December in TN. So it's happening everywhere.
Yeah.
So there's one farmer or the other farmer who's always a little less happy. And then you have FCI in Raigad, in Chhattisgarh, or FCI in Punjab, who decides that they have enough of poor quality rice or damaged grains, and they want to offload it, whatever be the quality, into the market at a loss which only the government can take. So it's not a private enterprise. Now here, I can only, I don't think I can even start appreciating the challenge that the food secretary or the ethanol ministry have, because for them to balance the stakeholders, and these are, we can just sort of, at this small conversation, we can put together at least 8 or 10, 12 stakeholders, and you start increasing the net, it becomes wider. So for a government to come up with a single policy on even a single industry, I think it's a challenge which I think government best tackles it. It's not for me to advise. But I think in what it is doing really a remarkable job. 2 years back, we had a problem. We said that we want to scale up our ethanol production to 10 billion liters. We had no hope in hell to get to that number. Through certain incentives, whether it be incentivizing maize farmers to plant more, to get better yields, through thankfully better rains in UP, we got good rice production, we got good wheat production, and now we'll have good cane production. We are coming at a position next year, which will be, I think, a problem of plenty. We'll have a lot of rice, we'll have a lot of maize, we'll have a lot of cane. The use, obviously, is, the government will have to now look at which child is trying out the most. I have a feeling that with the UP elections around the corner, it will be the sugar industry which will probably look for the most help. And rightly so, because sugar industry has not had an MRP increase since, I guess, 2019, when it was 31 rupees. And 31 rupees is not relevant at all, by any measure. The ethanol numbers, like Mr. Ranka is saying, are not leading to any accretive gains. You have a 61 rupee ethanol, and 59 rupees is still very efficient ethanol manufacturing. So that's not accretive. So I have my belief is that what Sahil was saying in terms of increasing price, I think that's more like round the corner. We had a lot of discussion towards the end of last year, where both these numbers came about. But I think some prudent minds thought that exports would be a better way, and I think it really played out very well, because 1 million ton exports helped increase the price of sugar from 33.5 to right now 38. I think next year there'll be some other sucker that will come through, which probably is in the form of either MSP or in terms of ethanol. And my money, if anything, would be on MSP. So that's how the industry will take care. But I think the government is also working on multiple ways to increase the ethanol usage itself, whether it is E30, whether it is SAF, whether it is even blending in diesel, which is a different challenge. But I think those are things that are happening around the corner. So I have a feeling that you cannot look at the industry, whether it is sugar or ethanol, as a single dimension or even as multiple dimension. It's a very wide scope industry, and you have to see how is it that one is getting impacted, to see which policy is going to sort of work out to the best advantage. So long answer, but I hope it answers.
No, it's a comprehensive one, but a very interesting reply. So thank you for those insights. Sabu, now I just move on to you. What Anup was just mentioning, like we were also talking, that distillery capacities have increased across the industry. However, like we were talking, the return and the profitability from this segment, like when we really compare the selling price and how the cost has gone up, they've not been very lucrative currently. And FY26, like we've spoken of in the presentation, we are expecting improvement, but not like how it was or how it was envisaged with this plan. So according to you, like how is the industry approaching to the returns and payback in the today's cost environment? Supposedly these increases do not come through very quickly.
So essentially, we are now looking at two issues. One, of course, is that we have already reached close to 20% blending. Now the point is, if you want to grow further, there has to be visibility on the demand. I mean, unless some of these new initiatives like SAF or blending diesel, ethanol with diesel comes through, we are looking at some kind of a constraint on the blending side, because for that the automobile industry has to be willing to come out with more flex fuel
Your vehicle.
vehicles. But again, the automobile industry also to come out with flex vehicles, they also have to be very sure of where the technology is headed in the basic thing. Is it that EV is going to completely at some point in time going to replace the IC engine? So the industry also has to be very clear on that, because their willingness to invest in flex would also depend upon what is their view on IC versus electric vehicles in the future. For example, if the industry comes to the conclusion that in future EVs will really take a very large share, I'm not saying that that's the case, but if they come to that conclusion, their willingness to invest in flex fuel vehicles may not be very high. So we have to look at what happens on the demand side. Secondly, also, as both Mr. Ranka and Mr. Kumar have mentioned, it also depends upon the government policy. For instance, there is this dichotomy between fuel and food. For example, because of the elections and the government's fear that because of reduction in sugarcane production, the sugarcane prices could shoot up. They put some restrictions on use of juice for manufacture of ethanol, and that created a lot of problem for the ethanol industry, including particularly the standalone ones. So obviously, the industry will also need, the ethanol industry, whether it's related to the sugar or standalone, they will also need some kind of roadmap from the government to ensure that they have adequate availability of feedstock, whether it's sugarcane derivatives or food grains, and whether the prices are also kept at prices both in terms of the feedstock as well as the final prices. The government gives a very clear signal that a certain minimum margin per liter and capacity utilization is made available to them. So some kind of a guarantee, although it may not be in explicit terms, will be very necessary from the industry's point of view. They have to keep investing in the ethanol capacities.
Okay, okay. Maybe we can hear from Mr. Ranka. So are you really expecting, the MSPs to increase? Like the government and, the industry players are kind of really lobbying. But like Mr. Kumar spoke and also Sabu, we all are kind of in a hope. The ethanol prices also, we've only seen a revision happening in the sea last year. And MSP, obviously, we all know that has not been increased from a pretty long time. But do we hear any shout outs probably around the corner of the sugar season starting,
No,
the next sugar season?
It's like last year. Last year also we were expecting the MSP would increase, the ethanol prices would increase, but there were some other factors also, the elections. There are a lot of things that goes around, and but if you look at go back to 2017, 18. At that point in time, we had surplus sugar in the country. We didn't have an ethanol blending program. Evacuation of sugar was difficult, prices were lower. And I think at that point in time, yes, there were all these FRPs and all, but the government the mindset was right, actually. They put an FRP in place properly. Okay. You have, so everything is controlled, the FRP is controlled, put material price is controlled, the offtake, how much you produce, when to produce is also controlled, who do you sell to is controlled. In that sense, of what price you sell is also controlled, MSP and all that stuff. So while this thing was nice, but if you start moving one of these parts, then you got to move in totality. You cannot do in isolation, and that's what, as Mr. Anup Kumar also said, you move the FRPs, you moving every year, and today from 2,550, it was roughly in 2018, and today you are at 3,550 for the next year per ton. Per quintal, which is almost like a 40% increase in the raw material cost. Okay, and this is a fixed price I'm talking, not talking about the other component as well. And then you see the MSP, what has happened. It is moved from 29 to 31. Yes, one would say, look, your prices today, your market price around 37, 38. That's fine, but then my cost is also gone up tremendously. Okay, so the MSP moving up is very critical. It brings about the sentiment changes actually. That MSP has to go up. The needle has to go up to that level, at least at the cost, and they have to send the right signal. Actually, the government has to send the right signal. And same on the ethanol prices also. We talked about it, everyone. These ethanol prices also has to go up. Now, whether the government will make the change or not, I mean, I think this time they will do. I mean, it's just a feel. I think this time with a lot of voices, whether at various levels, I think at this time they will have to do. And with the food inflation also, under control, at least for the country. If you see this year around, okay, inflation, total inflation under control. The worry is always a food inflation. So versus the total inflation. So the food inflation being under control, the government may, I think, increase the MSP price and ethanol price. And it looks like, but I'm keeping my fingers crossed totally on this front.
Okay, sure. Thank you. In the wake of the time, I'll just take the participant questions. There are quite a few questions. Maybe I'll just take them and I'll pose it to all of you. Anup, maybe you can take the first one. Herein, Aditya is there who's joined us, and he's asking, with increased distillery capacities over the years, especially the grain-based, what would be the competition and impact on margins as the allocation is now based on bidding?
So the bidding is, I think it's not an open bid. It's not an open tender. The government, or rather the OMCs, decide how the feedstock split happens. And they decided basis multiple factors. They don't decide on which is the cheapest split. I mean, if you have to look at it from the OMC's side, then any ethanol which is coming from C-heavy should be the one most favorable, right? Because that's the cheapest ethanol that is made in the industry. But I think it's done basis a wide variety of factors, which I do not have any line of sight of. So I don't think I'm the right person to answer this question. But I would say that it's largely based on multiple factors to which we have no visibility. Yeah.
Okay. Mr. Ranka, maybe you can take the next one. Here, there's a guy called Saurabh who's trying to ask, what is the per unit capex cost currently in setting up the ethanol plants, both the grain-based and even the molasses-based? Is there a differential, and what is the payback period given the current pricing in the industry?
So based on my experience, and I'm talking more of cane, roughly around 100 crores, high-level number for 100 KLPD plant. Okay, you don't do in 100 KLPD, you generally do around 300 KLPD plants. These are good optimum size plants. So you end up with 350 crores of capex. So that's the kind of capex that will turn. And in terms of payback, it depends. The assumptions that you make. And I'll tell you, typically in our assumptions model, we've used interest subvention as one of the key assumptions because there's substantial interest cost saving there, and it adds to the cash flow. But with the money is not coming in time, the subsidy money is not getting released by more than a year, and there are always an interpretation issues when you go to subsidy, because the ministry or the canalizing agency will have the nodal agency will have certain interpretation of when you can get this money and when you cannot get this money, and then you're stuck with that. So all this, so calculating, and if all things go well and you get the price that you want, I think a simple payback of 4 to 5 years is 4 years is there for ethanol plant, but very difficult to compute or give a rough high level estimate considering this.
Sure. Sabu, we've already spoken about this in the presentation, but here there is a participant, Hari Krishna, who's asking, what are the key risks in the ethanol as the OMC stopped the long-term agreements? Also, if the government doesn't really, extend the interest subvention programs, and the major flex fuel takes a little longer, how is, India heading to, or where are we heading from the E20? Very broadly, if you can take it up.
I think, the point is, I think it really boils down to, what stance the automobile manufacturers take. I mean, obviously, if the government wants to make it compulsory, that's a different issue. But otherwise, given the, development on the EV side, we have to be a bit circumspect about whether, the automobile manufacturers will be very keen. I mean, will be we can't assume it is to be taken for granted that they will be very aggressively pushing flex fuel. And obviously, if that demand is not there, obviously it's only if that demand arises because of the growth in the flex fuel fleet, would the OMCs be equally keen on off taking greater volumes of ethanol. And obviously, any kind of discontinuation of support in terms of inter-subvention or any such method will be negative from the perspective of the volumes, capacities.
Okay. And Anup, maybe you can take the last one. Here, the person is trying to ask, what can India learn from the global, since you have an experience there as well, the global other sugar producing nations, and who have higher blending from ethanol perspective as well. So both on the sugar and ethanol things, what is there, more that India can learn? Obviously, introducing flex fuel vehicles and growing more ethanol is one thing, but is there more to it?
Well, I think that the world has to learn from India. And I look at the ethanol program. We were not 2%, I think 5 years back.
Yeah.
Today we are 20%. The challenge for turning flex fuel is not a policy challenge. It's a challenge from the infrastructure, because a flex fuel would mean that you have a new set of pumps across the country. Globally, Brazil has it. Even as we speak, this morning I got a message from Brazil. There are 26 millers from Maharashtra, Karnataka, and Haryana in Sao Paulo visiting the sugar mills. I was asked to coordinate with our Brazilian office to arrange a visit for them to the Brazilian industry and to make a presentation on the industry. So the Indian industry has taken to ethanol and to the globe like fish to water. Indian exporter, including Renuka, are among the sharpest sellers. They can give you a price and they're absolutely adored across the world. So I think we have done pretty well in terms of meeting the global challenge. I don't think we are learning as fast. So I think I really don't have a wish list. I think that India has a lot to teach the world.
Okay, great. That's that. From here, we come to the end of our webinar. I would like to thank each one of you for taking out your time and all the insights that you have provided to us. Over to you, Mamta, for closing the session now.
Thank you, Ravleen, for moderating the session, and Sahil and Sidharth for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Thank you, Mr. Ranka.
Thank you, Mr. Ranka. Thank you.